I want to welcome back to the show Jesse Felder of the FelderReport.com. Also has a great Twitter. Welcome back, Jesse.
Thanks, Elliot. It's good to be back with you.
Yeah, I'm really excited to have you back because last time we talked was around June of this year, 2021, and there was a war raging between the inflationist transitory group and the inflationists. And I think Cathie Wood was on one side, you were on the other, and you won in 2021, right? The big question is like 2022 now, though. So how do you see the whole inflation story playing out in 2022?
It's an interesting question. From my standpoint, I don't really think that, I wouldn't even say that, transitory, people who thought inflation was transitory have really given up. I mean, Jay Powell has said that it's clear that inflation is not transitory, but I think, you have folks on that side of the argument, like David Rosenberg, who have made the point that, if inflation runs hot for 18 months, 2 years, that can still be transitory. So I think it's still an open question as to whether this surge in inflation is the beginning of a new prolonged period, or if it's just something that will go away and things will return to normal, the normal that we've gotten used to over the last 10, 15, 20 years. And I think that, that is still an open question. I am still of the mindset that I think we have opened a door to a new path for inflation. And there's a lot of different, things that go into that. I don't think that we're going to see inflation be transitory in the sense that it's going to come back down to a below 2% level for a sustained period. It's certainly possible that we're not going to see CPI readings over 6% for all of next year. They might fall back, but even if you look back at like the 1970s, you had CPI readings that spiked and then came back down, and it was just kind of a trend of higher highs and higher lows, and I think that's probably what we're going to see going forward again. It's possible that we see inflation peak somewhere in the first half of the year and start to subside to a degree. But I think, that's when the transitory crowd is going to start saying, hey, look, we were right, inflation's not. But that's not necessarily the case. I think for the transitory crowd to be right, we'll need to see inflation come back below 2% and stay there for a while. If inflation stays above 2 for a sustained period, I'm talking several years, that's, to me, that's going to be the ultimate arbiter of who was right, who was wrong in this debate.
So does that mean if inflation, is going to be sustained higher than most people are expecting on the transitory side, do you think that commodities will still be bullish in that type of environment?
Well, I mean, that's a good question, right? Commodities, you can say I want to own commodities because inflation is going to be high, but you also look at inflation is probably going to be higher because these fundamental backdrop for commodities is so bullish, right? So that you look at demand for, let's talk about oil and natural gas and energy products and these things. And you look at demand for these things is essentially back to normal, back to pre-pandemic levels, but supplies are not. And so that is a very strong, case for that. The oil price is back over $75 a barrel, and it's probably not going to go back below that anytime soon. We could see oil prices back over $100 a barrel very easily. If the economy stays relatively strong, the oil price is going to just keep going higher because supplies are just not there. And with this whole environmental framework, which I think we do need to have as a society of, reducing our dependence on fossil fuels, there's going to be less and less money invested in these things, which means supplies are going to be even tighter. So I think that's one point. We also look at, my friend David Hayes made some really good points in this regard, that what we're probably going to see over the next few years or 10 plus years is greenflation. So this transition away from fossil fuels is going to be very costly in terms of the use of things like copper and lithium and all these things. I mean, I saw an astounding, stat. I mean, I think a lot of people don't realize that I think it's still less than 2% of all car sales today are electric vehicles. Well over 90% of all car sales are still gas vehicles. So even if We went to 100. We banned the sale of gas, cars that are powered by gasoline, and went to 100% EVs just today. You're still going to have decades of needs for fossil fuels because all those cars are going to be on the road for decades to come. And so it would take years and years and years and years to transition. So right now we're only, I think, fewer than 2% of cars on the road fewer than 2% of sales today are EVs. And still look at the price of lithium, right? Lithium is the most important component. It goes into the batteries of the EVs, and lithium prices are soaring, right? Screaming higher. So imagine if we tried to go to 5% of all car sales are EVs, or 10% of all car sales are EVs. We're going to triple, quadruple the demand for lithium, and prices are already up 3, 4, 5, 600% in just 3-6 months time. So the demand for nickel and copper and lithium and all these types of things that go into EVs, and not just that goes into the production of solar, goes into the production of windmills and these types of things. They're all super commodity heavily focused things. And so this demand for commodities is going to continue to go higher, while same thing in a lot of these mining companies, they're facing structural impediments that are from governments around the world that prevent them from investing in meeting that demand with increased supply. And so the bull market for commodities to me is just a supply demand framework. We've seen a 10-15 year period where investing in commodities has gone down, 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 down. And when you remove capital, from a sector, you're going to raise the prices in that area, and vice versa. So we've seen this huge bear market in commodities that has resulted in huge lack of investment. And at the same time, we're going to be ramping up demand for the use of all these commodities over the next 3, 5, 10 years. And so to me, that is the biggest argument for owning commodities. Now, it just so happens that the best way to protect the best way to protect your investment portfolio against inflation is by owning a lot of commodities. And I personally prefer commodities focused businesses.
Yeah, that makes so much sense. And that's a great answer to whether or not commodities are going to be bullish. There's a real good fundamental framework for a bullish commodity story. But the question is, and it's kind of a weird situation where just all risk assets seem to just trade on what the Fed is going to do. It's like risk on, risk off. And in that regard, it's like, we talk about a lot about uranium on this show, and it's like, oh, look, uranium's down 10%. Well, so is ARK, right? They just trade in tandem. So like, is everything, including commodities, just tied straight into what the Fed is going to do? And right now they're saying they're going to raise rates in 2022, which is bearish.
Yeah, I think, one thing that people, I think the biggest mistake investors make is taking the recent past, extrapolating it out into the future. Another way to say that is recency bias. They think whatever has happened in the last 3 months, 6 months, 12 months, 2 years is going to happen over the next 3, 6, 12 months, 2 years. And right now you hear a lot of talk about the Fed is going to raise interest rates. That's going to be bullish for the dollar. And it's going to have all these ripple effects in commodities and gold and whatnot. But when you think about how the markets work, right? The markets right now are already pricing in a full tapering of QE by March, right? Asset purchases by the central bank going to zero. And at the same time, it's pricing in the first rate hike in March and potentially 3 or 4 rate hikes during 2022. That's what the markets are pricing in right now. So if that happens, that's already priced into the markets, right? Dollar doesn't need to go any higher if that happens. Gold price doesn't need to go any lower. Commodities don't need to go any lower if that happens. That's what markets have now discounted. So where it gets interesting is, okay, well, then how are markets going to react? Well, they're going to react to either a hawkish or dovish surprise to what's now priced in. So if you think the Fed is going to be even more hawkish than that and be able to taper down to zero and then get 4, 5, or 6 rate hikes next year, then you might want to be betting against commodities, betting against gold, and betting on a higher dollar. But if you think that the Fed is not going to be able to follow through on that, that they're not going to be able to taper all the way to zero. They're not going to be able to pull off 3-4 rate hikes without crashing the stock market, crashing the economy, and doing all these things, then you think there's probably going to be a dovish surprise versus that consensus. Then you want to be short dollars, you want to be long gold, you want to be long commodities. And so I think that, yes, right now the world revolves around the Fed. That's just the way of things, right? When you print over $1 trillion a year and lower interest rates to zero, you have the most deeply negative real Fed funds rate in history, right? That has incredible ripple effects across all markets right now. And so the unwinding of that is the number one most important factor in markets. Personally, I come down on the side of things. I don't think the Fed's going to be able to pull off everything that's priced in right now. And so to whatever extent there's going to be a dovish surprise sometimes next year, that's going to be bearish for the dollar, bullish for gold, bullish for other commodities.
Makes 100% sense, right? But then what about just the S&P 500? It doesn't seem like it's pricing in anything negative, right? It's just sustained.
My friend Julian Brigden has made the most brilliant point here, is that the pressure on the Fed now to reverse this policy is so huge. And what is the most important factor that people are looking at? They're looking at the stock market, right? There's no way the Fed's going to do X, Y, and Z and it's going to affect inflation, tomorrow. It just doesn't work that way. So the Fed has to do something that tightens financial conditions. There's a bunch of things that go into financial conditions, but maybe the most important ones are corporate bonds, spreads, and the stock market. And so, what Julian's point is that the stock market doesn't understand, investors don't understand that the Fed has to keep going with hawkish policy until the stock market comes in, because that will be the sign to the world that they've done enough to tighten financial conditions. And so right now, the market is not really reacting, but there's going to be a time where the Fed is, continuing to taper asset purchases, maybe getting to zero on that end, and starting to do 25 basis point rate hikes. They're going to do that until the stock market corrects. And so I think, and the other side of it too is that inflation is running so hot right now that, if the stock market goes down 10%, that's probably not enough for the Fed to make another dovish shift and say, oh, okay, we're all done with rate hikes. Is it down 20? Is it down 30? I don't know how far the stock market has to go down for the Fed to switch dovish again. But right now, we're in a situation where, we're back to, Jay Powell, 2015, 16, 17, 18. And, we're so far behind the curve that we're going to be hiking rates from here to eternity is essentially what the Fed's telling us right now.
So it's almost like betting on a bullish upside in January, February in cryptos and tech and things like that is doesn't seem likely, because what you're saying, the Fed wants the stock market to correct 5%, and they're going to keep doing what they can.
I think they need the market to correct more than 10. I mean, they probably need another. I mean, you think about it. In 2018, the fourth quarter of 2018, when the stock market went down 20% in the one quarter, that was enough to get Jay Powell to go, okay, all right, we're not going to hike rates anymore. Don't worry. We're not going to roll off the balance sheet. We're going to, maintain the balance sheet, and made the classic Powell pivot. But inflation wasn't running, 6-7% back then. It is running 6-7% today. So you could argue that the stock market would have to go down more than 20 at this point for the Fed to say, okay, that's enough. We don't need to hike rates anymore. There's also the side of it too. I mean, to me, it's astounding that the Fed has had, so much time and such a strong economy and strong stock market to start unwinding this policy. And that they didn't use any of that time over the last 18 months, where you had a huge economic recovery, huge recovery in the stock market, and they didn't tighten policy at all. Now we have slowing economy, we have slowing earnings growth. We're probably going to have an earnings recession in the S&P 500 next year. And that's going to be led by the FANG stocks, the biggest tech stocks right now. Look at the NASDAQ 100 earnings growth is supposed to go negative next year for the NASDAQ 100. So you have this fundamental deceleration and actually, a depreciation in NASDAQ earnings. At the same time, the Fed is turning really hawkish. And there's all kinds of technical warning signals that I've been writing about too for a couple of months that suggest that, correction's coming even without the Fed, but the Fed, removal of liquidity, tightening of financial conditions is also going to have its own effect.
Exactly. And that's kind of what I'm seeing too. I mean, the Fed is telling us they're hawkish, which is never a good sign for the markets. And so you're going to see commodities get even softer, probably. You're going to get stocks get even softer. Does that mean that just like in March of 2020, it's just the mother of all buying opportunities once you do see that correction and like maybe go into some tech in addition to commodities? How would you allocate your portfolio at that point?
Well, I mean, I have very rarely wanted to own the, SPY or QQQ. For me, I'm always looking for individual stocks that present unique opportunities. And so, there are times where I have I've taken off all my hedges and I'm fully long and I'd be happy to own the broad market. But I personally feel more comfortable owning individual stocks that I feel have an individual margin of safety. So, it's tough for me to look at that and say there's going to be a time. I mean, the market is trading, at the highest valuations. This is what I worry about most, right? You look at something like the Warren Buffett yardstick, which is the total value of the stock market relative to the total size of the economy. And right now we're like 30-40% higher than the peak of the dot-com mania. So what does that mean? That means stock prices could fall 30 to 40% and still be as expensive as the most expensive stock market in history, right? So stock market falls 30% doesn't make it cheap. That's one of the things that I worry about, especially in a high inflation environment. In a high inflation environment, you typically see price earnings ratios in the single digits, right? NASDAQ 100 trades over 30 times PE right now. So you have to have this is just how the math works. You have to have a 60-70% decline in the NASDAQ to get to single digit PEs. And, I'm not saying that's going to happen, but that's why I don't want to own the broad market, because from a margin of safety standpoint, you don't get there unless you get one of these epic bear markets like we saw in 2008, 2001, 2002. I think the most comparable one to today currently is that 73, 74 bear market, where stocks, especially the Nifty 50 stocks, the most popular stocks in the market, got absolutely hammered in about 18 months time. All went down 50, 60, 70% in a short period of time. So valuations in 1968, prior to that 73 peak, were a fraction of what they are today. Valuations are 2 to 3 times higher today. So it wouldn't be surprising at all to see that type of occurrence, happen again.
I got what you're saying. So yeah, you find the stocks with good fundamental stories that are undervalued, have good, valuations and good fundamental backdrops. And that's what you're saying, commodities, especially compared to tech stocks. And you just brought up like the 70s, at which point stocks crashed, commodities ripped. You don't think there's going to be a decoupling of commodities versus stocks like in the 70s? Is that
no, I absolutely do think there will be. I mean, you look at, there's two groups I'm looking at specifically right now that I think present investors with the most interesting opportunity. One is oil and gas producers. Those stocks are, were the best performers this year, and nobody cares. Nobody cares. I mean, to me, that is fantastic. That's exactly what should happen in the very early days of a bull market, right? You have something that has been left for dead because it's performed terribly, and then 1 year out, it does phenomenally well. I mean, these oil and gas stocks blew doors off of any tech stocks or anything you want to look at this last year, and still nobody wants to own them. That's a beautiful contrarian indicator. For me, they're still extremely cheap. I mean, a lot of these stocks still trade 5-6 times enterprise value to EBITDA. And that to me is just investors saying that we think the oil price is not going to stay where it is. Oil price is going to go back down. Because if the oil price stays where it is for any length of time, these stocks are way, way, way too cheap. And the biggest, reflection of that, a stock that I've owned for the last, little over a year, is Continental Resources. Harold Hamm is the billionaire founder of that company. And last fall, a year ago, October 2020, and after the earnings call, he said, look, I'm going to be buying as much of the stock with my own money as I possibly can. He bought $150 million or something in the first few months after that with his own money. This is not just like we're buying back stock as a corporation. And he just bought in the last 3 months about another $30 million worth of stock. The stock's already tripled in the past year, but he's still buying a ton. You have another stock, Energy Transfer, which is a pipeline company and terminals, company for natural gas and things. And, Kelsey Warren, the CEO there, just bought $120 million of stock in one day because the stock has a 7-8% dividend yield. And we're going to be continuing to move these products across the country for as far as the eye can see. We're not going to shift from, fossil fuel based economy to getting rid of fossil fuels tomorrow. It's not going to happen for decades. And investors are acting as if it's already happened. So you have these stocks, they're incredibly cheap. One of the things I look at is you look at the price of oil and the relative performance of oil-based stocks. And usually when oil prices are really strong, those oil-based stocks outperform the S&P 500. When oil prices go down, those stocks underperform the S&P 500. We've had a huge surge in oil prices in the last 18 months. And the oil-based stocks have really just gone sideways. So it suggests to me that relative performance needs to be rectified somehow. Either these oil and gas stocks need to continue, to be very, very strong, or the S&P 500 needs to come down, or some combination of both. And I think that's probably the most likely thing. So the other side of that is, gold mining stocks. I think the gold price, if you have a dovish surprise from the Fed next year, where the Fed says, okay, we've pulled off full tapering, we've pulled off 2 rate hikes, we need to stop now because the stock market is down 30%. The gold price is going to go over $3,000 an ounce. The gold price is going to go to the moon because investors are going to realize the Fed is trapped. The Fed, if you have inflation at 6% today, the Taylor rule, John Taylor invented this, and it was basically a systematic way of understanding where monetary policy should be. The Taylor rule suggests the Fed funds rate should be 8% today, and it's at 0. And so if the market comes to the conclusion that there is no way the Fed can normalize monetary policy, gold prices, commodities, all these things are going to explode higher in the next leg. And so I think that's where we're headed. The catalyst is going to be, like I said, a dovish surprise from the Fed sometime next year. And the gold mining stocks are another one where the gold price has been really strong for 5 years. This last year has been relatively weak, but I think that's just this trepidation in front of a hawkish Fed. When you look at rate hike cycles of the past, gold prices go up. 2015-16, the Fed started hiking interest rates, gold bottomed and started going higher. The Fed started hiking rates in 2004, 5, 6, 7. The gold price went from $250 an ounce to almost $2,000 during that rate hike cycle. So I think we're going to see a period where these stocks, their relative performance goes dramatically in their favor. Gold miners, oil and gas, a lot of these commodities focused businesses, but I think that's going to be a function of those stocks doing well, but also the S&P 500 doing poorly.
Yeah, that is such a great analysis of the gold price because the sentiment probably couldn't be worse than it is right now on gold stocks. And it's because they think the Fed is still in control, which it seems like they do have control of the market right now. So if they're saying they're going to lower rates or raise rates, well, then they will, and that's going to hurt stocks. But that is very true. Any dovish surprise and gold will just take off. That's a great point.
The Fed can rein in inflation. The way they can do that is if they tighten interest rates and they create enough of a stock market crash to create a recession.
Right.
Right. We've all kind of known, Ben Bernanke talked about this a lot, about we're trying to support asset prices through QE to create a wealth effect, make people feel wealthier so they go spend more, right? The Fed knows that they can also create a reverse wealth effect, that if they let the stock market go down 20, 30, 40%, people are going to go, oh no, I need to now tighten. When this is a recession, I need to tighten my spending. I need to do all these things. And it becomes a self-fulfilling thing. So the stock market is now the thing the Fed tries to manage. So if you think the Fed is willing to crash the stock market and create a recession in order to rein in inflation, then yeah, you don't want to own gold. You don't want to own commodities. You don't want to own any of these things, because the Fed is going to crash the economy. Now, if you think, though, that the Fed is only going to use its forward guidance and things and to try and be hawkish to the point where that becomes a risk, where they risk creating recession. And at that point, as soon as that risk is clear, they're going to say, okay, hold on, stop. We don't want to create a recession. Then you have to be extremely bullish commodities and gold and all those things. And I don't think the Fed is willing to. I mean, there's so many people already talking about a policy mistake. And so the Fed is not willing to make another policy mistake where they tighten, to the point where they crash assets and create a recession. And so they're going to try and have their cake and eat it too, which is try and talk hawkish, do as much as it takes to kind of appear as if they're addressing inflation, but they're not really able to do so. So, and when the market, there's going to be that epiphany in the market next year, I think, and that's going to be a huge bullish catalyst for gold and these things.
Right. So the Fed will be trapped. They're going to have to lower rates, and there's going to be a dovish surprise. Commodities are going to rip. And I guess at that point, once the market realizes the Fed is trapped, you're saying they won't want these like growth exponential age story stocks as much as the inflation oriented commodity.
I mean, that's a good point too, because part of the reason gold has performed poorly this year is that real rates were suggesting that gold had gotten ahead of itself late in 2020. And so it was the fundamentals were pointing to, you should be underweight gold actually as of, the summer of 2020. But, every risk asset this year, I mean, you can say, yes, a lot of these things, peaked in maybe January, February, but you've seen every type of risk asset has done really, really well this year. So investors have said, gold is a safe haven. Why do I need to own a safe haven, right? And when literally any risk asset I buy is going to go up and do really well. So the flip side of that is when you start seeing some of these risk assets potentially do poorly, people go, oh, wait a second, maybe I do need a safe haven again. I need to start allocating back some into gold. That's another dynamic too. I think the Fed dynamic is much more important, but this other one, this idea of a safe haven, is also crucial in respect to gold too. So, if you start seeing a risk off period, that could also, and I think that's potentially what gold is sniffing out right now. I think a lot of people don't appreciate either that the dollar has been really strong recently. And the gold price has only been making higher lows. And so if, gold were just the inverse of the dollar, right, it would be rolling over hard right now. So this relative strength in gold compared to what's going on in the dollar is a very bullish sign, I think, that smart money is accumulating gold in anticipation of these things, and in anticipation of a risk-off period that makes people think they need a safe haven again, and also in anticipation of a dovish surprise by the Fed.
It's a great point, and just something to end on, because we talked about these natural gas pipeline, stocks that are yielding 10%, 8%, really look like insanely good value. But it's hard because like the BlackRocks aren't buying, like the big whales can't even touch these stocks, and that's probably hurting that performance you're talking about. So it's like
that's something that I always look for, is that when you have a structural impediment to investors being able to buy something, usually results in bargain pricing. And so right now, that's what ESG is doing. ESG mandates for investors across the whole investment universe is preventing investors from buying all these oil and gas stocks. Well, that leaves terrific valuations for somebody like me. You also see that in it's a totally different topic, but the cannabis stocks, where the multi-state operators literally trade on the pink sheets, and the vast majority of investors have zero access to them, institutional and retailer. And so you have valuations there that are incredibly cheap for companies that are growing 2 to 3 times faster than the FANG stocks. And the valuations are a tiny fraction of those companies. So yeah, you talk about if the stock market rolls over, is it going to create opportunity in tech? I'd rather buy some of these multi-state operators in states where they have same profitability as these big tech stocks, much faster growth and much greater potential growth ahead of them, and much more attractive valuations. So yeah.
So even if like the whales in Wall Street aren't pumping their money into it and lifting the price, you're saying like the dividends, it will still be incredible, right? Just like they are in natural gas and things like that.
Well, so it makes me think of one of my favorite quotes from Jim Grant. He said, the object of investing is to have people agree with you later. And so you want to buy things right now that people don't have access to. But later on, as cannabis becomes federally legalized, or at least they pass safe banking at the federal level, these things that make it possible for investors to start, then that changes the whole dynamic, where now people can commit capital, and now the valuations are going to normalize and all of these things. And so same thing with oil and gas. People are going to realize, okay, maybe ESG is fundamentally flawed in the respect that we have to have fossil fuels to transition. We have to reasonably price fossil fuels to transition us to this no fossil fuel future. How do we do that? We find the companies in the oil and gas business that are doing this in the most responsible way. Maybe they're using carbon capture and other technologies to reduce their carbon footprints. That's where we're headed. And investors in ESG are going to say, okay, you know what? Maybe I should own some of these fossil fuel companies, the ones that are doing it right, because then we can reward them for doing things in a way that's environmentally responsible, but still also helping us transition with reasonable cost fossil fuels. So yeah, I want to own things. I want people to agree with me later, right? People don't agree with oil and gas today, but maybe a year from now, 2 years from now, they're going to realize, a lot of these companies can do this in a responsible way.
Absolutely. That is very comprehensive, thoughtful way of looking at markets. Super helpful. Where can people go to stay on top of your updates and learn more?
Well, I think you mentioned at the top of the show, my site is thefelderreport.com. I try and put up a blog post there once a week. I also put out like a free Saturday morning email that goes out with just some of the best charts or articles that I read during the week. You can sign up for that right on the homepage of thefelderreport.com. And then I'm pretty active on Twitter. I'm kind of anti-social media generally, but Twitter is a really interesting network of ideas and people I follow there. I get a lot of value out of that. So I try and give back and just share a lot of what I'm seeing there. It's just at Jesse Felder on Twitter.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.